This looks like a gas price story. It's not. This is the kind of shock that wrecks people's budgets, their credit, and their ability to secure housing without them realizing what's happening until it's too late. In this War Financial Survival Guide, I'm going to show you how to protect your money from inflation during the energy crisis. Because it can hit your groceries, your debt, your mortgage rate, and your home buying timeline all at once. The Strait of Hormuz carries more than a quarter of global seaborne oil trade. Brent crude briefly jumped above $119 a barrel on March 19th, and mortgage rates have already ticked higher. Meet Nadia. She had a down payment saved, a decent score, and a plan to buy in the next year. Then fuel got more expensive, groceries got uglier, utilities started creeping up. She kept telling herself it was temporary, so she covered the gap with cards and locked in a bigger car payment because she figured rates would fall later.
6 months later, her monthly cash flow was tighter, her balances were higher, and the house plan got weaker. Not because she was careless, because nobody explained how an energy shock actually hits a household balance sheet. This is why this channel exists. I break down how financial and mortgage decisions actually work, so you stop guessing. Remember, this is educational only, not legal or financial advice. Talk to a licensed professional for personalized help. Here's the chain reaction. Oil is not just gasoline. It hits shipping, trucking, airline costs, farm inputs, packaging, and eventually the shelf price of ordinary stuff. The Fed's long-run inflation target is 2% on PCE inflation, and energy shocks make that job harder. Freddie Mac's latest survey shows the 30-year fixed mortgage rate averaged 6.22% on March 19th, up from 6.11% a week earlier. This is the part people miss. An oil shock becomes a cash flow problem before it becomes a recession conversation. People wait for CNBC language. Your budget feels it first. When prices jump, your first job is not to outinvest inflation. Your first job is to stop your life from going into emergency mode. That means this order. 1. Protect income. 2. Protect cash flow. 3. Protect housing. 4. Protect credit. 5. Then worry about investment optimization. That is the real financial survival guide. Because if your income is shaky and your bills are bloated, inflation investing is not step 1. It's step 5. If you want to survive and stay afloat in a financial crisis, start by freezing new fixed payments. No oversized car loan, no lifestyle upgrades, no "I'll figure it out later" furniture financing. No draining your reserves just to look like you're still on schedule. Here's where people get hurt. They think inflation means they need a more aggressive portfolio. What they actually need is fewer forced monthly payments. Real wealth protection strategies in a shock are boring. Lower fixed expenses, more breathing room, more reserves, less debt pressure, more margin between your paycheck and your bills. And if you're trying to buy a house, every dumb payment you add now can hit your debt-to-income ratio later. The CFPB says emergency savings help protect you from things like repair bills, medical costs, and income shocks. Keep that first layer of crisis money accessible. A savings account can make sense here, including a high-yield savings account if it keeps your money liquid and insured. FDIC deposit insurance generally covers deposits up to at least $250,000 per depositor, per insured bank, per ownership category. And federally insured credit unions have comparable NCUA share insurance rules. That means your stay afloat money should not be doing something heroic. It should be doing something useful, being there. If your emergency fund is small, fine. Build it anyway. Small liquidity beats fake sophistication every time. If money tightens, stop paying bills based on guilt. Pay them based on damage. The CFPB's bill prioritizing tools say that when you can't pay everything, make a short-term plan and think through the consequences. The FTC says to contact creditors immediately if you're struggling, instead of waiting until accounts are deep in trouble or sent to collections. So your order is usually housing, utilities, food, medication, insurance, work transportation, then unsecured debt. That is not soft advice. That is survival math. Call and say, "I'm reaching out before I miss a payment. My cash flow is tightening, and I want to stay current if possible." What hardship, payment plan, due date, or fee relief options do you have available right now?
That line matters because you are calling before delinquency, not after damage. If you are a buyer, this is where the mortgage insider filter matters. Don't let an energy shock turn your down payment into your emergency fund. And don't let a new car payment quietly kill your approval odds. As oil prices spiked this month, markets also scaled back expectations for Fed rate cuts, and mortgage rates moved higher. So building your plan around "rates will probably bail me out soon" is weak planning. Ask your lender this exact question. At today's rate, what payment keeps my DTI safe if gas, groceries, and utilities stay elevated for the next 6 months? And how much reserve cash would you want me to have left after closing? That is a much stronger question than, "Do you think I can afford it?" Because now you're speaking in underwriting language. And underwriting language gets better answers. FHFA says homeowners facing hardship should immediately contact their mortgage servicer or landlord to see whether payment relief is available. CFPB says mortgage forbearance can temporarily pause payments or reduce them. And both HUD and CFPB point people to housing counselors who can help with buying, defaults, forbearance, foreclosure, and credit issues. If you only remember one thing, remember this: do not wait until the file is ugly. Call early. Call and say, "I'm calling before I miss a payment. My monthly expenses have risen, and I need to understand every hardship, repayment, or forbearance option available on this loan. What can we review today, and what documents do you need from me now?" That is how adults stay afloat, not by pretending it will sort itself out. Do not assume higher prices automatically mean a recession is guaranteed. Do not assume rates are about to crash and save you. Do not move emergency money into risky bets because the news feels dramatic. Do not burn your full down payment just to say you bought the house. Do not keep the expensive car if the car is what is making the house impossible. That last one stings, but that is the math. So here's the simple version. If you want to know how to protect your money from inflation during an energy shock, do this. Protect cash flow first. Keep emergency cash liquid. Prioritize bills by consequence. Call creditors early. Avoid new fixed payments. Stress test your housing budget. And if you're already squeezed, get help before you go delinquent. That is how you survive. That is how you stay afloat. And that is how you protect your wealth without pretending a scary headline is somebody else's problem. Drop your situation in the comments. Are you in cash protection mode, debt cleanup mode, or house buying mode? And how many months of reserves do you have right now? That will tell me what lane you're in, and I can build the next video around the most common one.